good morning. Hi, Simon. Hi, Derek. Good morning, good morning, good morning, everybody. All right, we're going to let everybody come into the room here a little bit. I'll just move you guys over here so I can see you. And we'll start the webinar very soon. How's everybody doing? Screen and sound good? Everybody's seeing everything all right? That's great. That's great. That's great. Good morning, good morning, good morning. Well, a super busy day in the macro markets already, a lot of volatility, a whole bunch of news. I think really nothing gets discussed except the war effectively, because I think the war is just clearly driving everything that's going on. So the latest headline news swinging back and forth after a pretty horrific day and night of civilian bombing that the Russians have incurred on Ukraine, with lots of civilian buildings. I don't know if you guys are watching the video streams from Ukraine, but there's just horrific damage to a lot of civilian targets in Ukraine. Latest sort of positive note was that they were trying to do peace talks again. Both Ukraine, it's really unclear though if the talks are going to take place. And they're at a low level, so nobody really holding any hope for talks. So lots of explosions in Ukraine here. I'm just looking at the at all the latest news here, and this is the Russian control. You can see that for all of the movement, the actual area of control that Russia is controlling is not significant, given the kind of military might they've put in there. But from the market point of view, there's just so many different flows that happen overnight. The most obvious, the most interesting from a market point of view was, of course, the move in oil. Let's just take a look at the 1-minute chart, and it was it was truly a parabolic move. So it was interesting. President Biden had a State of the Union address, and it was kind of interesting because during the State of the Union address, so he starts around pretty much around here, 9 o'clock, right? You really, oil goes to 110, challenges, the big area, and just kind of consolidates for most of Asia, and then come Europe around 2 o'clock. I've been up since about 2 o'clock in New York. We just have this explosion and move all the way through the 112s to the 1250, and then just a complete parabolic blow off in oil as it compresses. Now, these are all, of course, 1-minute moves, tiny little moves, but still the price action, if you're just sort of looking at a daily basis, what you're seeing here is this parabolic blow off top, series of lower highs, and a break at a 110, which is the mid range of the day today. And the really interesting question here is, has oil really peaked, or do we have more to go? Now, if we look at the longer term charts, if we look like at big daily charts, obviously it's had a big peak. But if you look at this candle, that's a really ugly flow candle, and I caution everybody from interpreting anything, because even you had this big flow candle, a big wick candle over here a couple of days ago, didn't matter. Escalation of activities continues to create more and more pressure. If we look at the monthly chart, which is kind of how we have to go back, we're essentially right here. We are back from the 215 highs, and it's really interesting to see if that's going to be effectively a reasonable level of resistance, kind of a double top resistance. Of course, from a micro point of view, a couple of things are happening. So everybody is scampering to get oil reserves because Russia's been cut off. Russian oil, for all intents and purposes, has been taken off the market. Now, all of this is going to translate into some very serious price shocks for everybody. It's gasoline in the U.S. is around, let's say, $4 a gallon, an average. Because I'm in Jersey, it's around 3.5 in Jersey, and it was 5 in California. So let's just say it's 4. It's very feasible that we see $5 gallon gas pretty much universal. Now, how that's going to impact the U.S. economy is going to be an open question, because my suspicion is it's not going to affect it nearly as much as people think. Yes, it's going to be a major cost, but the U.S. economy seems to be so strong right now as far as demand goes. It's just simply going to translate into higher wages, and people are going to, they're going to be paying more for gas, but they're going to be getting $20 an hour on a minimum wage to offset some of those costs, and people will just minimize the use of gas as an input. So I think there's a natural top here. There's kind of a natural top in oil, both technically and fundamentally. It's very, very tough to, of course, step in front of a moving train. But, when you look at these kind of parabolic moves in the commodity, both up and down, so here's the move where we, what did we initiate? 105 to basically, that's about a $50 move, right? That was a $50 move before it finally found a little bit of support here for 3 or 4 months before, it kind of just essentially found the bottom. So conversely, this is pretty much a $50 move to the upside, 60 to 115. I guess my point is, I think it's reasonable to begin to initiate shorts on oil all the way up to 120. So it's got to be a scale up trade. So you can initiate it to short here at the 110 level, 115, 120, and your ultimate stop is going to have to be like somewhere around 130, 135. You literally have to trade it that wide if you're trading it on a positional basis. If you're trading it intraday scalping, that's a completely different story. But if you're trading on a positional basis, it's really, to me, very much a story of like scale up shorts. 110 here, 115, 120 with a stop at around 130, 135. I think that gives you a really reasonable chance for a double top and a formation to the downside. Because the other thing that I think people have to appreciate is, and it's granted, it's very much a war of nerves right now in the Ukraine. The war is horrible as far as civilian casualties and the violence that's being imparted. But the war is actually being run on 2 fronts. There's obviously the war against civilians and innocent people that is being waged. But the other war is the war against the Russian consumer. You have to understand that the Russian economy has no value whatsoever except for oil. Nobody's buying Russian oil. Therefore, the Russian economy has no access to anything, to any kind of a consumable good. Now they may consume their own, their own wheat production and stuff like that, but that just reminds me of the days of the old Soviet Union when I was a little boy, and everybody would go to the store for a single loaf of bread. Russian consumers have been fully westernized, have been fully capitalized, have very, I think, normal middle class expectations at this point. And there's just an enormous amount of hardship that could be coming, which in turn, by the way, this is my point of why oil goes down, is if there's enough pressure here to cease the violence, the first thing Russia is going to do is flood the market with oil in order to just get enough money so they can get some bread. That's really kind of going to be the trade-off as we go forward. So while everybody now is focusing on the squeeze, I think the tsunami the other way could be pretty brutal. And to me, the much more intelligent trade here, given that we're effectively at a double top formation, that huge amount of this squeeze is not demand driven, but simply artificial supply driven, meaning that they took supply off the table. The U.S. is going to now flood the market with 30 million gallons from the SDR reserve. Is all positive. I don't know. I don't know where the Biden administration is going to go down on all of this, as far as whether they're going to lessen the regulatory oversight on oil and gas companies. In other words, allow oil and gas companies to resume drilling and continue energy. I mean, I think if anything, this geopolitical conflict has brought very much front and center the need for energy independence, and that this whole pie in the sky, let's all create a windmill situation is just utterly untenable. I mean, of course you want to minimize the climate impact, and probably if you're sort of looking at sectors that I think have an incredible future potential, I think the consumer nuclear sector, that is the ability to build small nuclear reactors all across the world as a not a stopgap, but kind of like a intermittent, as the intermediary between, let's say, full green energy and the dependence on hydrocarbons, is really the next step. But we'll have to see, how Western government. I mean, we'll see if Germany has to flip around on this. France, of course, one of the interesting things you notice about the geopolitics of the world is that France has been very, very dominant in opposing Russia, right? Whereas Germany has been, has kind of joined the opposition, but it's always been lagging. And what's the difference between France and Germany? France is fully self-sufficient economically because they have lots and lots of small nuclear power plants all across the country. Germany made a tragic decision not to pursue safe nuclear, and they're just effectively dependent on Russia. And I think if we've learned anything from World War II, is that you should never depend on fascist countries for anything. So lots of interesting things, I think, from a longer term economic point of view. From a shorter term point of just trading, as we're looking at the markets right now, oil, of course, is the dominant story here of the war. And to me, we're closer to the top than we are to the bottom. As a matter of fact, I actually just put out a Twitter poll saying, what do we see first, 120 or 100? And so actually, let's take a look at how that poll is going. Let's see what. Let's see, where's my poll here? Interesting. So it was 50-50. Now it's 65-35 that everybody thinks oil goes higher. Most likely, this is interesting. I mean, of course, everything is contingent on what the next headline is. But generally, when you have that kind of a skew, it's much wiser to go to this. You always want to be on the opposite side of the majority view, because the majority view, by its very definition, is going to be wrong. So it's sort of interesting to me that I think everybody is just affected by that. So what do I think caused the gold to drop around 525? Oh, I think it was the I'm not sure, honestly, the 525. There was no news headlines. I mean, it looked like it was just a massive what do you call it? A massive dump in gold. Let's take a look at gold right now as our next idea here. And where's gold? Here's gold. So I'm looking at a longer term chart. So let's just take a look at the most immediate chart. Oh, what's happened to my thing here? What did this? Oh, I need to. Sorry, let me do this. I was like, okay. So I don't know. This is a great question. This looked like some kind of just a massive dump, a little bit of liquidation, and it's hard. It's almost impossible to say whether somebody just kind of dropped a couple of hundred contracts out of Asia or whatever into the move. Gold has been, to me, a lot of people are very, very bullish gold, and I think you certainly have to respect the move in gold here. Look at the dailies. The move in gold has been inexorably to the upside here, right? I mean, a very, very clean, clear move. But again, gold, very similar to oil, had this flame out candle, and this is what I want to show you that I think is interesting. If we go to the monthly chart, what do we see? This is, I remember this monthly spike as clear as it was yesterday. This was the beginning of the pandemic. I remember trading the 2000 gold, the 2000 gold. So, I think from a technical point of view, the really interesting story is we're setting up for a double top, right? And my view, basically, technically, in both oil and gold, is that until and unless these double tops are broken, you go with the assumption that they're going to fail. You're going to, in other words, until you see gold clear 2100 and hold it on a monthly basis. In other words, clear and hold 2100. You really, the intelligent trade here is to short into the 2000s. And again, I'm talking as a longer term swing trade, not as a day trade. As a day trade, you could certainly buy the dips and let it trade all the way up to the 2000, 2100. That's probably the safer way to go. But if you're positionally trading for a couple of $100 points, not just for $10 or $20 in gold, but a couple of $100-point move, it makes eminent sense to me to be able to short gold. Again, in a scale-up version, 1950, 2000, 2050, 2100 with like a 2200 stop, right? Because again, you have resist here, all of these areas, and those areas look extremely resistant to me. I mean, the gold is spiking on effectively war fears. And in some ways, some of the worst news may be already behind us. We'll have to see. If I'm wrong, I mean, I think the critical thing here is you assume that it fails, but then you let the technicals prove you wrong. To me, that's the right trade. Instead of chasing the move to the upside now and thinking, oh, it's the end of the world, everybody's putting money into gold, you gotta get long because it's going to be a 100-year war. The one thing I'm very confident about is it will not be a 100-year war. The one thing I'm very confident about is that the Russian consumer, 30 days into this thing, seeing empty supermarket shelves and no ability to have their money. Their money right now, the dollar, the ruble is worth 10 cents. Well, what it was, 10 kopecks of what it was just a couple of years ago. You literally lost 90% of your money overnight in its exchange rate. I don't think it's going to be like a long duration conflict. I also wonder, and I mean, I really don't know because it's Kremlin, so it's it's almost wishful thinking on my part, but I really wonder how long Putin will stay alive. He has endangered the whole country, embarrassed the armed forces in many ways. The problem is it's Russia, and he's got lots of cronies behind him. But of course, the single greatest move for peace right now would be a bullet in his head. So anyways, hang on a second. I'm sorry, just 1 second. What's going on over here? Kathy is just texting me something. I just want to make sure she's fine. Okay, just 1 second. I'm going to make Kathy the presenter. So basically, the big stories to me, and I'm just going to finish up with crypto with you guys, and I want to turn it over to Kathy. Just give me 1 second here. Let me just find her over here. Where is she? Huh. I don't see Kathy. Oh, there she is. Sorry. Okay, I got her. Okay, let me just make her a presenter. Okay. Oh, hey Kay, sorry. Did I?
Yep, it's working. Hello, everyone.
All right.
I'll let you
Sorry,
finish. Once you have a fresh, then I'll share my screen.
I gave up the screen a little bit too early for you because I didn't get a chance to talk crypto. So do you mind if I take it back for a second before you?
Yeah,
before
go
you,
ahead.
Okay, sorry. We just, it's our, okay, show my screen. Sorry, I'm on the wrong screen now. Hang on a second here. Okay, so here we go. So let's talk, well, the final thing, the final thing to discuss is crypto, which I think is actually looking extraordinarily good. So this is obviously very, very long-term charts. We have, Bitcoin double topping over here, but here's the thing that I want to keep you in mind. Remember where gold and oil are very, very close to their historical double tops, triple tops. Bitcoin has still got 30, 40,000 or 20,000 points to make to the upside. And when you look at, the trade here on this is the daily chart. After topping out in December, we're basically consolidating and looking quite good. Now, everybody is talking about it from a technical point of view in Bitcoin, that this 46, 48 zone, this zone over here, that's the zone that needs to be really clear. Basically, if you think about it, it's kind of around numbers. If Bitcoin clears 50, it has a really, really strong chance to go higher. Now, what's driving the trade in Bitcoin? I think some interesting footprints going on over here. So remember I told you that effectively all of Russian savings have been embargoed and completely destroyed in the sense that the Russians cannot use their money anywhere except in Russia, which is useless, right? This is terrible for the man on the street, but it's actually incredibly difficult for the oligarchs, all of whom essentially have had their assets frozen, right? And are unable to get a hold of all of their other bank accounts and everything else that's going on here. What's being reported on most of the crypto exchanges is that there's what's known as a lot of whale activity. Whale activity is when somebody buys like 1,000 Bitcoins, like, large 8-9 figure transactions. And that coincides very much with, if you look at this massive, look at this bar. We went from 37 to 41. I remember this, we literally went 1,000 points in 1 minute on this bar. This was the 28th. So what makes this kind of a day interesting was that was the day when we basically said the Russian central bank reserves are going to be frozen. They can't use their foreign reserves for anything. And I think that created this massive flight to Bitcoin as a store of safety. Because remember, you can't carry 200 bar ounces of gold out of your jean pocket, but you can put $2 billion worth of Bitcoin into a drive and just walk away with it. And I think what you're seeing is a lot of Russian oligarch wealth, which is in the billions of dollars, and it's very, very quickly being sort of sequestered, quickly being transferred at any cost, because it doesn't, they don't care if they lose money or not. They just need to, they want to preserve their wealth into Bitcoin. And that seems to be like a perpetual persistent bid here. Now, how much of this has been transferred, how much more is there to go, remains an open question. But if you're looking for a fundamental support story of why Bitcoin is suddenly looking, a much more like what it was meant to be, a store of value, then it looks quite good. And you have to, respect this move in a very serious way. So for Bitcoin, the next level is 45. If we can hold and break 45, that's very, very bullish. And then after that is the 50. Those are the big things. But overall, essentially, it's buy the dip in Bitcoin until proven wrong. Until if we take out the 40,000, if we take out the 38,000, then this whole thesis kind of gets evaporated. But the net short of it is it's sell gold, sell oil, buy Bitcoin as the longer term trades on my end. And now I'm going to turn over the rest of the show to Kathy, because I think she wants to talk to you, of course, about FX and all of the impact it's having on FX today and going forward. So I'll give you the screen, Kay, and you can go ahead.
Okay, great. Thank you very much. If you can share with me the screen, I haven't seen the option yet.
Change presenter. Well, you're the panelist now, right? So should I give you?
Yeah, I don't have the.
Okay, sorry. So let me see if I can change presenter to you. Okay, I got it. Let me see. Okay, got it. Okay, I made you a presenter. Now you should have the screen.
Okay, wonderful. Everyone see my screen? See my screen? I think you should see my screen.
Well, no, not yet, not yet. You got to share it. We're not. There we go. Now we see it. Okay, now we're good. Okay.
Okay, so in the world of currencies, we have a lot going on this week, and a lot of it is related to the fact that we have the Russian invasion and the implications it has not only on risk flows, but also on what all of it means for the monetary policies of these central banks. I mean, this is an important week in the sense that we had the RBA rate decision. We had the RBA rate decision, and we also had the Bank of Canada rate decision later today. We have Fed Chairman Jerome Powell speaking, and we also have the non-farm payrolls report. And so all of that, is obviously very significant. And what we're seeing in terms of the market developments, what the worry is that all of that is going to affect policy. So the first thing I want to talk about is why we're seeing such a huge divergence in the performance of the European currencies versus, for example, the Australian and New Zealand dollars. The euro is very weak. The euro is basically trading at its lowest level that we've seen it since, I think, since May of 2020. And sterling is not as weak, but it is still the weakest that we've seen this year. And the reason for that is because the Eurozone and the UK are much more sensitive to what is happening is much more sensitive to what is happening in the oil market and also the sanctions than Australia and New Zealand, for example. I mean, the Eurozone and imports about 40% of its gas supplies from Russia. And the Australia and New Zealand, for example, where Aussie and Kiwi, which are up today, while Euro and Sterling are down, and we're also up, or at least fell less yesterday when we had a bloodbath in those markets, you have zero reliance on Russian oil. So from that perspective, the invasion and the rise in oil and the lack of oil supply is having a very dramatic effect on how these currencies are performing against each other. And it is no coincidence that all of this is, for example, causing Euro Aussie to trade pretty much at its lowest levels since 2017. Now, I talked about how all of this impacts policy. I mean, today's a very important day, and I'm really glad we're speaking because the question is, oil prices are well above $100 a barrel, have spiked significantly over the past few days, week or so. And so, how is this going to affect the thinking of central banks? If we look at oil alone, and if this happened in a vacuum, central banks would be saying, okay, we need to raise interest rates aggressively. March is the month for rate hikes. Fed is expected to raise interest rates in March. And if we were looking at oil alone, it'd be 50 and not 25 for sure. Today, we have a Bank of Canada rate hike that is expected. And the choice is also between 25 versus 50. The Canadian dollar is up today and not as weak as some of the other currencies because Canada obviously has their own oil supplies and are not reliant on Russia. And if it was purely based on data as well as inflation alone, the Bank of Canada would need to raise interest rates by 50 instead of 25. But we obviously don't live in a vacuum. And while stocks futures are up today, we had quite a bit of a sell-off in equities over the past week and change. And that plus the uncertainty created by the Russia is expected to intensify its attack on the Ukraine is leading to risk aversion that is going to make the central banks a little bit more conservative. So so these two questions are really very much at the forefront today. And I think both central banks are probably still they're most certainly going to say that tightening needs to happen. They're probably going to be a little bit more conservative and say that it's a little too early to determine whether we are going to see whether or not we're going to see or we're able to see the impact of the invasion on asset classes. So, if that is the case, we've already seen the dollar rally. If Powell kind of downplays the impact so far, or kind of pushes it off and focuses on the need to get ahead of inflation, US yields to rise and the dollar should rise. I actually wrote this in my note. If we read 60-Second Investor, I wrote about how that the dollar might rise and yields might rise into Powell's speech, and we're obviously seeing that today. So what you're looking at right now is my heat map, and every single week I put together a heat map with my fundamental views, because Boris talked a lot, I talked a lot, but and while you may understand it, it's things change all the time, and it's hard to get a full grasp of what the fundamental outlook is and understand what the outlook is. And that's why we create this heat map for our members so that we do the work for you. So at the beginning of the week, we talked about how we're dollar bullish, and if you expand this, there's more details on why. We're dollar bullish because the most important reason, obviously, is because the dollar is a safe haven currency, and with all the Russian uncertainty, we believe that money will flow into the safe haven currency, and that's been happening. It's continued to happen. And there was a little bit, we had to be a little selective because we had the huge drop in US Treasury yields, and dollar yen, dollar Swiss did not perform as well, for example, as the dollar against the euro, the dollar against the British pound. But still, I'm still bullish dollars. I still think the Fed, when Powell speaks and delivers his semi-annual testimony today, he's going to reinforce the need to raise interest rates. The Eurozone, on the other hand, they've been a little wishy-washy. They're much more, the Euro area is much more sensitive on an economic perspective to the Russian sanctions, as well as the cutoff of Russian oil. So, they're going to hurt more. And, that is why Euro is one of the weakest currencies amidst all of this war talk. And so I think that's going to continue to be the case. Rate hike expectations have been pushed from 2022 all the way to 2023 for their first interest rate hike. So I'm bearish. I'm going to remain bearish. We have been bearish for some time. I'm neutral sterling because the Bank of England has been raising interest rates, and they plan to continue to raise interest rates. But like the Eurozone, though, they are much more sensitive to Russian sanctions, Russian oil and gas supplies. So it's definitely going to be a neutral bearish outlook. The Australian dollar, they're far less hawkish than the money of the other central banks, but their economy is improving, and data has been improving, and they've been recovering. The warmer weather has allowed their economy to recover from COVID restrictions. So I'm bullish Australian dollars, and with the oil situation, we already talked about how Australia and New Zealand are far less sensitive to Russian oil, and so money is flowing into that country because they believe that their economies are more shielded and will see less pain as a result of everything that's happening. I'm also bullish Canadian dollars, and I've been bullish Canadian dollars all week because of the expectations for Bank of Canada tightening. New Zealand, I'm neutral bullish the New Zealand dollar. It was simply because we're not bullish Kiwi, because New Zealand had already raised its interest rates, and Kiwi was a very sensitive risk-on currency, and this week was much more focused on Aussie with the RBA. But I'm still bullish Kiwi because they're hawkish, plan to still raise interest rates, and the economy is less sensitive, particularly on the relative basis. Boris will tell you, I love trading Euro Kiwi because there's such a huge divergence between how one and those two countries or parts of the world are economically. And then I've been bullish Swiss francs and the Japanese yen for weeks because I was expecting some sort of crash in the markets, and that is only solidified by all the uncertainty that we have. So we've got non-farm payrolls coming out. Aside from the big events that we talked about, we also have non-farm payrolls coming out on Friday, and typically that's a very big release, and I think it's still going to be an important release, but I think it's going to be less important than today's testimony by Powell, as well as just kind of the headlines related to the Russian incursion. So what you're looking at here, first I'm going to show you my moving average chart. And my moving average chart in Eurodollar obviously shows you that, we're in a downtrend below all of the key moving averages. And, in some ways, we are kind of getting into oversold territory. So you have to be a little careful. In terms of where support and resistance is, we're below the key fib levels already. But underneath us, we do have, we've already broken below the 61.8% fib. That was important. So below us, we do have the 78.6% fib, which is coincidentally right at 110. And I think that that's where, support is for the Eurodollar. If we look at this chart, which is my 1 hour zip chart, we sold euros here and we sold euros here. Caught some small profits here, caught some bigger profits here. We're in oversold territory. If I opened up the candle and I was ready to trade today, and today we don't trade because we don't trade ahead of major events, and because we have Powell's speech and such a big uncertainty, we may have consolidation before that and not get the moves that we had. But if I opened up my screen and I looked at this, I actually would not sell either, because it looks like we have a huge wick followed by a bit of a recovery candle. So we could recover a bit even though we are amidst in a downtrend. So I would personally be staying out of that. But in general, though, I'm still very bearish euros and bullish US dollars. I just don't think that we may get that traction today. So I'm also bullish dollars, a little less so against the Japanese yen, but today I have to be, because whenever I trade, there are three components: fundamentals, technicals, and sentiment. And with stock futures up, treasury yields up, that is support of the dollar. See, even though in my brain, I think that, there should be ongoing risk aversion because, this evasion is going to intensify, the market's telling me that that's not what it's thinking about right now. It's telling me that it's bullish, that risk is recovering, which is positive for dollar yen. We do have resistance right at 115.30. So sorry, on the 4 hour chart, and also on the daily chart, we're sitting right at resistance at the 20 SMA. So it doesn't look great to me in terms of getting in. And then I'll check my zip charts, and my zip charts actually turn positive. So when the price goes above the indicator line and the background, which is indicative of the long-term trend, turns green, that's a positive signal. So this actually looks kind of good. So if I was going to choose between Eurodollar and dollar yen definitely looks better of the two to be trading this morning to the long side. Dollar Swiss is not doing much. It's kind of trapped between the moving averages. It's range trading, trying to bounce, not giving us too much direction. We can check our daily charts. We see that we had a zip sell signal, but this is why we don't trade. We don't take our zip signals on big event days because it's very prone to reversals. We're now back above the line. And, if we drop back below it, then maybe I'll get a sell signal again. But right now, it's just whipsawing. Sterling, in terms of sterling, we're below all the major moving averages, still bearish. Support is at this zone here around 132. That's really the level to watch. And then on the zip chart basis, we had rallied. We're pulling back. I think, I'm going to check the 4 hour charts. No, I think, you should stay out of it. I was going to say maybe it should pull back again, but no. The 4 hour charts tell me we're still in reversal mode, and that, this, that we shouldn't be faked into selling this rally. Aussie, Aussie is in a, is in a range, but towards the upper band of the range, because we're above the 2050, 100, both below the 200 SMA. Resistance, this is a key swing high that's going to be resistance at 7.3 and change. If we look at Aussie and the zip chart, it looks beautiful. So we actually have a zip buy signal in Aussie. So I really like this trade because from a technical perspective, we have a zip buy signal. From a sentiment perspective, we are risk on in terms of stock futures being up. So that looks pretty good. And so, this looks like a pretty good trade. I can guarantee you that AussieN's also in the zip buy zone. So AussieN's also in the zip buy zone. So I think Aussie itself, which is a pure zip signal, or AussieN could move higher ahead of Powell. Now, once again, I'm standing aside because of the event risk, but it doesn't look bad. Kiwi dollar is looking very much like Aussie dollar. Resistance is up first at the swing high here at 68.10. But it's just kind of consolidating. It's not doing much. On the 1 hour charts, it's trying to zip up. Now, we are in a range trading environment, but, Kiwi, Aussie, if I was in the vacuum and we didn't have Powell today, those would be trades I would be taking, because on a fundamental perspective, those two economies are less vulnerable to Russia, so money's flowing in. On a technical perspective, we have the zip buy signals. On a sentiment perspective, we have Dow futures up. Today is Bank of Canada Day. This is the one that could move ahead of the 10 a.m. rate decision in Canada. So if I was going to front run anything between now and 10 a.m., it would probably be to buy Canadian dollars. We haven't formed the zip sell signal yet, but I think we will. And if we look at the dollar CAD chart here, you will see that we're still kind of range bound, but we're dropping below the 20 SMA, so that looks kind of conducive. On the 4-hour chart, looks really good. Looks like it wants to drop to the 200, which is 126.75. So a quick scalp before the Bank of Canada rate decision could be an opportunity that we see in the Canadian dollar. The other trade that's possible is maybe long CAD yen, which is also consistent with my pro dollar yen view, as well as the rise, which is actually better because treasury yields are up. And then also, we have stock futures up, which is positive CAD yen. The other charts that I like is euro pound to the short side, which takes away the Powell risk and focuses on euro area's vulnerability. You do have to be tricky because pound is very much a risk on currency, but I think euro pound to the short side does kind of look a little attractive. Other signals that we're seeing is Aussie Swiss is zipping up to the long side, and if we look at Aussie Swiss on the daily charts, it does still look bullish. Kiwi Swiss also looks bullish. CAD Swiss not so much, but these are the clean zip trades. If you went long when you got the first zip signal at 5 a.m., if you had the zip strategy in Aussie Swiss and Kiwi Swiss, you would have been a much better price. CAD Swiss is just about to form zip long, which is consistent with my bullish CAD view ahead of Bank of Canada rate decision. All right, so that's basically the look at the currency market from a fundamental basis, looking at my heat map that we give to our BKForex members, and also from what our zip signal and our technicals are telling us this morning. So do we take questions, Boris, or because I can't see the questions on my end?
There is no, I'm looking for any questions. Does everybody have any questions? We'll give you a couple of minutes here to ask us about anything about the markets. Looks like everybody has gotten a full briefing. So the quick takeaway from all of this is I'm sort of scale up short oil and gold, scale down long Bitcoin, and what would be your top 2 or 3 currency trades, not necessarily on the next hour basis, but like let's just say on a longer term weekly basis. What do you like the most?
I like the Aussie, I like the Kiwi, and I still like dollars, US dollars.
Okay. All right. So US dollars against what? Would you be buying them against euros?
I still like buying them against euros. I think they're very much vulnerable. Yes.
Okay. All right. So those would be the right trades. Okay. I don't see any questions. So we are going to be back next week. Happy to discuss anything with you. If you guys have any questions, just email us at contact@bkforex.com. Otherwise, everybody have a wonderful day trading, and we'll see you guys next week. Everybody have a wonderful day. Bye-bye.